Morning, everyone. So good morning, everyone. It's a real pleasure for me, to share this session dedicated to oil. So this morning we'll have three very, very interesting presentations. We'll have the first presentation will be dedicated to an analysis between crude oil market and financialization. And we'll start with Sania. The second paper will be dedicated to the lithium industry and the analysis of the beta term structure of the oil companies. And we will finish with another very interesting paper dedicated to the effects of oil price modeling approach and the economics of instrument to procure financial security for decommissioning. So Sania, I leave you the floor. So the rules of the game are very easy. You have around 20 minutes for your presentation, and after that, we'll have a Q&A session. Please, Sania.
Okay, thank you, Emmanuel. Can you view the slides?
Yes, it's okay.
Yes, that's perfect. Thank you.
Okay. Hi, everyone. I'm Sania Wadud. I'm a joint PhD student at University of Aberdeen and Curtin University, Australia. I will be talking about one of my working progress paper on connectedness between crude oil futures and equity market during pre and post financialization era. This is a joint paper with my supervisor, Robert Durand, and my previous supervisor, Mark Grunwald. Today's presentations, I will quickly go through the backgrounds of my papers and also talk about the theoretical view and empirical view I have considered and our research focus and our strategy on the empirical framework and empirical findings. And then I will talk about a bit of robustness check and then conclusion. So since the implementations of Commodity Futures Modernizations Act in 2000, there has been significant change in commodities markets. So many investors started to invest in commodities. So this has increased the investors' interest in the commodities. So there are a few motives for which actually investors started to invest in commodities. And this may have actually countervailing effect, which I will discuss in the further slides. One of the reasons that investors started to invest in commodities was low correlations with equity and equities with commodities, and it allowed them to diversify their portfolio. Moreover, commodities offer competitive return rates and also can be used for hedging against inflations or exchange rate. So around in 2003 and 2004, there was a huge inflows of funds in commodities market, which increased the overall trading volume and open interest in the market. And concurrently, it has elevated the price and volatility. If I have shown over here the changes in price that it increases, especially for S&P 500 from 2004, and also in commodities, which is I am showing over here is the front crude oil futures contract. And it drastically changes, and there are some dips which are due to some events. Moreover, there was notice that there is positive correlations between net hedge funds positions and futures prices, and due to significant interest in the commodities market, and there was a huge evolutions in market participants. So both commercial and non-commercial positions were high, and especially the non-commercial long positions was much higher. If you look into over here, the green line, the non-commercial positions was much higher than the commercial long positions. So this increase, it shows that there was actually a drastic increase in speculators in the market. And this increase in non-commercial long positions are often known as financializations of commodity. So within this two period, like pre-financializations and post-financializations, the main difference was the presence of the speculators. So in this paper, we try to see that whether the speculators are actually changing the link between crude oil futures and equity market. So what this development mean? It could have some potential impact. It could be negative and positive. If you think about the positive impact, blockchain shows that it could actually help in efficient derivative pricing methods by using different features and different maturities. And Pirong shows that when the speculation is high, it reduces the market price risk by adding liquidity, and it stabilizes the crude oil price. And Masters mentions that it could actually break the relationship between prices and inventories. Before 2003, the relationship between prices and inventories were negative, but after late 2003 and around in 2004, it started to become positive. So one of the reasons was that the speculations actually increased the overall equilibrium price level, which leads to increase in productions and decrease in consumption, and that leads to actually increase in price, and the relationship between price and inventory changed. Moreover, Tang shows that in their paper that the spillover price over effect was much higher. So it's from financial market to commodity market, or it's around from commodity to commodity as well. Moreover, one of the theoretical model, Vesak and Pavlova, shows that there was increase among the correlations between commodities and also between equities and commodities. What is interesting over here, when there is low correlations and the trading activity gets higher, and this increase in trading activity actually increases the correlation. So it could actually change the overall equilibrium level of the connectedness between crude oil market and equity market. And it could lead to decrease in diversification's benefit. So if we think of theoretical point of view, so in theory, actually increase in non-commercial investors should allow efficient allocations of resources. This is because it helps to actually hedge against risk. Moreover, is if you think of liquidity, the liquidity increasing and the transfer of risk is increasing, which actually helps in efficiency in forecasting futures price, and that actually leads to decrease in volatility. However, in many occasions, we found that there is actually increase in volatility due to there is lack of information, or information is not coming in timely manner, and there is not enough transparency, which reduces the quality of information, and it destabilizes the price, and it increases the volatility. So in this paper, we focus our major concern was 5 of questions, research questions. First, we wanted to see whether the cross-market linkage between the crude oil and equity varied since the financializations. So we particularly looked into the volatility link. We also wanted to see whether the individual volatility of crude oil futures affecting the equities, or equities is affecting the volatilities of crude oil. And we wanted to see whether these volatility started to move synchronously. And moreover, we wanted to see both individual volatility of these markets is linked, how linked with the connectedness between the crude oil and futures, crude oil futures and equities market. Our main contribution was seasonality and Samuelson effect. So we particularly look into the volatility pattern, especially seasonality is very important in price variability, because change in volatility could be due to demand or supply change in commodities. Moreover, if you're thinking of investment decisions, it's very important that you consider seasonality, because it will show you the trend. Based on the trends, you can actually reduce your risk. Or if you are ignoring this seasonal pattern, it could increase your risk exposure. And in regards to Samuelson maturity, which suggests that in longer horizon, you will have lower volatility, and in the shorter horizon, you will have higher volatility. We also look into that along with their correlations effect. So what approach we have taken for this paper? We have taken 2 different approaches. We see subsample analysis, and also we measure financialization with specific commodity measures. And we have actually considered Varex DCC Garch model for our paper. One of the reasons is that because it allows us to see the spillover effect, also it allows us to see the simultaneously both correlations and time varying volatility. And then we take the estimated volatility and estimated correlations, and we run regressions and granular causality. And for maturity effect and for correlations effect, we do some other tests, which I will talk later. For sample period, we have chosen from 1993 to 2003, and for post-financializations period, we have taken 2004 to 2019. One of the reasons we have chose 2004 is in more past literature suggests that there was a break in 2004, and we follow that. Our main variables is the volatility of returns. I've taken the weekly returns, and I have taken up to 4th contract of crude oil futures, and for equity, and I have taken that S&P 500 index. And for extent of speculative measure, I have used speculation index and also open interest. We looked into open interest for 2 reasons. One, we could see the liquidity is impacting or not. Moreover, due to financializations, there was increase in open interest. We followed the Heidegger's for speculation index, which is actually net non-commercial long positions divided by the total open interest. So this is our overall findings. So after we run through the Varex DCC Garch model, so this Varex X is we use actually seasonality as an exogenous variable over here. So that's why we have used Varex. And other than that, it is a very standard model, and we didn't change much in this model. So I wouldn't go to the technical details of this model. Rather, I will talk about what we actually found. So for this model, we found that the stock return is affected by actually past crude oil return, whereas the crude oil return was affected by own past return. We also find that there is significant volatility co-movement in the market, and also the overall correlations was time varying, and it shows that it's mostly positive. So this is the results we find. If you see, this is a time varying conditional volatility we get, and the green line is for S&P 500 index, and the violet line is for front month crude oil futures. If we look into the pre-financializations period, even though it's synchronized, over this period, there was overlapping. So we couldn't say that it's fully synchronized, these 2 series. But if we look into post-financializations period, we didn't find actually any overlapping in these series, which shows that this volatility was start to actually march up together since 2004. And overall, we find the dynamic conditional correlations to increase. If you look, for example, the Hache point before financialization, it was 0.39. And if we consider after financializations period, it was 0.5. So it was quite increased. One interesting finding we had before financializations, we find that during higher periods of volatility, the correlations were lower. Suppose in these 2 points, when there was high volatility, the correlations was lower before financialization. Even over here, during the tech bubble, when there was a higher volatility, the correlations between this market was lower. However, this changed after financializations period. We find that during the crisis period, the correlations were higher. For example, in these points, when both the volatility of S&P 500 and crude oil was higher, the correlations is higher. There are, in many points, we find this. And also the regression analysis confirms that. So we run regressions, regressions, and we find there is no impact of actually either crude oil volatility or S&P volatility on either of the volatility before financializations. But after financialization, it drastically changes. We find that especially that crude volatility of S&P 500 impacts the volatility of crude oil, and also the crude oil volatility impacts the volatility of S&P 500. And this increase was more for higher maturity. So as it increases the maturity, the effect was much higher. When we look into the volatility effect on the connected between this market, before financializations period, we didn't find effect for every contract. Rather, we find it for every contract after financializations period, especially the volatility of equity market impacted the connectedness between equity and commodity markets. This result you can interpret like that if there is risk in the crude oil market. So probably the productions level will be hampered, and that will actually affect the overall stock oil price for that particular company, and it could actually hamper the overall stock market. And if you consider that if there is risk in stock market, what could happen? It could actually, it's dropping the stock price of that particular company, and that it could actually affect the production level, and it could, this fluctuation could actually impact the crude oil market. And if we consider about the commodity financializations, then we can say that due to financialization, what's happening over here, that crude oil is not being only used as an investment product, it's also being used as a derivative product. For that, actually, it's acting more as an asset class, and that has actually increased their connectivity. When we look into seasonality, our hypothesis was that the financializations will actually weaken the seasonality, and we find that before financializations period, there is seasonality, especially in fall during it's a big fall period. And we find that after financialization period, both in return and volatility, that seasonality weakens and fades away. One of the reasons behind is it being a substantially larger market, the equity market affects crude oil market more through financializations process rather than the other way around, and this has actually weakened the seasonality. For Samuelson maturity and correlations effect, we looked into a couple of tests. For visual inspections, we used distributions, and we also do parametric trains. Seeing the coefficients change, we could decide whether it's the Samuelson maturity and correlations effects holds or not. We also do some non-parametric tests, case tests, and JT tests for that as well, and which all confirms similar results. For Samuelson volatility effect to hold, what we expect that the front month contract, which is the nearest contract, will have higher volatility than the distance contract. Over here, the gray one is the front month contract. Then the second, which is the next nearby contract, is the orange one, and the green one is the third contract, and the most distant contract is fourth. And we would expect that it will shift to left. So that means that the volatility will decrease, and we do find it in that. So the crude oil is on the rightmost, and it actually shifts to left when the maturity increases. So we do find actually before financializations period that Samuelson effect holds. When we look into post financializations period, we do find that there is quite a range difference in volatility for these crude oils. But however, we find that Samuelson effect holds for this market, and it shifts from right to left over here. However, one interesting finding over here is like we find that when especially for the front crude oil, we find that the volatility actually decreased. It was over here around near 0.05, and over here it's like 0.046, which decreased. And whereas other contracts volatility actually increased, which shows actually the diminishing effect of Samuelson. when we look into the correlations effect, so that is whether the correlations between front and nearby front contracts, correlations will be higher than the front month contract and the distance contract. We do find that effect in both, in crude oil in both periods. We wanted to see actually how it will impact if we actually bring the equity into it. So we find that when we bring equity, this effect totally changes. And so as the maturity increases, the correlations actually decreases. If you see over here, which is the correlations with first contract and S&P 500, it's left. So it has actually the lowest correlations than these two. And this became more prominent after post-financializations period. And we call this inverse effect of Samuelson. For financialization specific measures, we also run some regressions. Overall, we find that before financializations period, speculative activity had impact on the estimated volatility, and whereas after financializations period, open interest has actually more effect on crude oil futures volatility. And it suggests that the speculative activity is actually increasing the open interest, which increasing the liquidity and decreasing the volatility of crude oil market. And when we run these regressions, whether to see speculative activities impacting the correlations or open interest is impacting the correlations or not, we didn't find any impact on that. We also, for the short run effect, we also run Granger causality, and we find that after financializations period, change in speculative activity may change the volatility of both markets. And whereas we find bidirectional causality between open interest and volatility. For robustness check, we have taken 3 different approaches. We use alternative model. We used ARGCC Garch model. Our results is robust based on that. Even with detrended open interest, it's that. So regarding the alternative financializations measure that we use both short-term and long-term, and we see that there is difference. When you are using actually short-run financializations measure, the result changes. So for our future research, we do have plan to actually see it into actually market microstructure manner and see how actually result changes or not. So overall in this paper, we find that since financialization, there was increase in dependency and volatility in both of this market, and there is weakened seasonality in this market, and we find diminishing Samuelson volatility effect, and we find prominent inverse Samuelson correlations. And moreover, we find that the change in speculative activity could actually drive volatility to change. However, there should be other factors we should consider and could affect this relationship. For example, if you think about fundamentals, the inventory could impact it, or if you think about extreme events that could impact as well. So we keep that for our future research. And moreover, we want to see actually whether this results differs for other commodities or not. And that's why we were working on another paper, which sees actually 21 other commodities. And we try to see the difference in that. That's all from me. Thank you, everyone. If we have any questions.
Thank you, Sania. Are there any questions in the room?
Hi, San. Oh, sorry, Arturo first. Okay.
No, sorry, Yusuf. You want to go first, please. Sorry.
Hi, San. Great presentation as always. So I'm just going to ask easy questions. It's about the is there any kind of like rule of thumb if you apply the VAR XDCC Garch? Is there any rule of thumb that in terms of the choice of the observations, like I mean like how many observations that it advise you to choose, and then like how did you consider to choose some specific certain start date and then end date? I mean, I know you explained there is some break in 2004, but then like, how did you consider your start sample observation date?
didn't do actually specific structural break test, but with VAR you could see the structural break, but we didn't actually include in our paper. But we actually followed the other literatures. But we see taken that from 1993 data because we wanted to have weekly data because CFTC data are weekly basis, and for the continuous series we needed to have the weekly data, and that's one of the reasons we have taken from 1993. Because before that it was a fortnightly data, and we didn't want it to change the series too much, manipulate the series too much by using spline methods or the other methods.
Is there any rules that how many observations that really suits with the far X DCC gauge in the literature?
In the literature, if you consider, you should have at least around 500 observations.
500. Okay.
So, and I did consider that in both samples, it was more than 500 samples. So that's why we chose that. Otherwise, if we use actually DCC gauge, it could have actually biased results. We did consider that. And one of the reasons that's why we couldn't actually consider the COVID period, because I won't have that many observations to actually run this data.
Okay. All right. Yeah, I think that's all from me. Thank you.
Thank you.
Thank you.
Hi, Sania. A very interesting presentation. Thank you very much. Really very interesting. And I wanted to ask if you think that, for example, your research actually can explain some of the things it's happening today in the oil market, because to me it's somewhat clear that there are many non-commercial actors driving prices up when the fundamentals do not sustain such high prices yet, right? Maybe, I don't know if your paper can give some light on those, or what you think it can be applied from that to this. It is more, it's not about your paper, but much more of how do you see current events using the knowledge from your paper, which is very interesting.
Yes, that's a good point. I might actually consider that one, but probably not for this paper. Probably in my future research, I would consider that.
Okay.
Yes.
Yeah, because I think it's really, the framework is really useful, and you can use some of your conclusions to explain what's happening in today's market. Yeah.
Thank you.
Okay, thank you. Are there any questions? Otherwise, I have plenty of questions.
Oh, yeah.
No,
I'm expecting those.
Don't worry about it. Just one point of clarification. Which contract did you take for crude oil? Brent, WTI?
Yes.
Both of them?
I have taken WTI crude oils. I didn't take the Brent oil, only the crude oil.
Okay. Don't you think that with a WTI contract, that could be a problem regarding storage, for example, and the link between the storage in the US, for example, and the price of a WTI contract?
Yes, we actually, for this paper, we didn't actually consider the storage and inventories particularly, because one of the papers as far as I remember, it was Priong's paper, which suggests that especially when we are looking into the speculations, it's better not to include inventories and rather see other driving factors. So that's one of the reasons we haven't looked into inventories. And moreover, another reason we didn't include that, because we wanted to see for other commodities whether it will change the results or not. For all the commodities which we are considering, for 21 other commodities, we don't have actually data for all those inventories.
Okay.
So that's another reason we didn't consider the inventories, but we do have plans. So if we could find actually inventories data for all these commodities, we do have plan for that.
Okay. So second question, if my memory is good, we observe a change in terms of classification at the Commodity Futures Trading Commission between the different actors, non-commercial and commercial in 2008, I think.
2006, yes.
I think it was after the financial crisis. My question is very simple. How did you manage? Because if I remember well, you know, what we call non-commercial and before the financial crisis and after the financial crisis, and more especially swap dealer, were not included in the same way, you know, in the CFTC classification. So how did you manage, you know, to take into account this change?
So I have taken actually CFTC COT data, which is a disaggregated data. So we haven't taken the data which started to probably provide from 2006, where actually money managers, swap dealers were actually segregated. But we have taken the data from before, so which shows that actually the long commercials and non-commercials data. So, but if we wanted to see from 2006, we wouldn't actually include a pre-financialization period. And that was one of our limitations, that we wanted to use segregated data and we couldn't use it. And moreover, like for publicly available data, I couldn't see even the micro structure level data, which we had planned for futures if the data is available.
Okay, just one general comment. First of all, thank you for your very, very interesting presentation. I'm very surprised, you know, because I worked on these topics, you know, 10 years ago, I think. And the problem that we faced at that time, we wanted, you know, to use daily data. And the fact is that I can see that 10 years after, you know, the CFTC does not want, you know, to give the daily data because they have the daily data. So it means that we are obliged, you know, to work as a researcher with the weekly data. And when you talk about financialization or speculation, the best way, you know, to assess speculation is to use the daily data. And so I'm very surprised that there are no changes, you know, regarding the data that we can have, you know, when we want to work on speculation. It was just a general comment, you know. You don't need to answer.
I know, actually, there are some paper. I think Berkshire's papers actually uses those data. He has that access.
He has an access, but I don't know how he got it. And this is my last question. At the end of your presentation, you talk about the fact that you will continue your work on different commodities. Which one? Which one could be interesting to work with?
Another working paper in progress. We have looked into 21 other commodities. We have segregated with its energy commodities, agriculture commodities, precious metals, and we see those effects for a couple of those.
Okay, very, very interesting. Okay, so I'm sure that we'll have a very interesting paper in the Energy Economics Journal or this kind of journal, you know, in the future.
Hope so.
So are there any questions? No? So thank you very much, Sania, for this very brilliant presentation. And I hope that I will be a reviewer, you know, for your next article, you know. Thank you so much.
Okay, thank you.
So we will switch to the second presentation. We'll have a presentation from Manuel from the Universidad Francisco de Vitoria in Spain. Manuel, you have the floor.
Okay, thank you very much. Okay, you can see my screen?
We can see your screen.
Okay. Good morning to everyone. Today in this session, I present my research paper titled The Lithium Industry and the Analysis of the Term Structure of Oil Companies. And the main question that I asked myself when I started to investigate were how lithium industry affects to the oil companies and in their relationship between systematic risk, the beta term, and the expected return of the oil companies, right? So the presentation, the main points that I'm going to speak today, I summarize in this slide: introduction, data, results, and concluding comments. Okay, so to start from the beginning, let's go to review the main literature. Okay, and in the case of the United States, Schur and Netzer 1960 exposed in their research paper the two energy transitions. One of them was the imposition of coal over wood as a source of fuel in 1895 with 65% of coal versus 30%. Also, 4.5 decades later, occurred the same with oil and gas, where the coal represented 28% and oil and gas 65%. So can the same thing happen with oil? If we look at the research done by Cherif et al. 2016, they conclude that, as in the previous cases, the same can happen to oil with renewable energies in relation to the transport sector in the next 10 to 25 years, okay? So most of you could ask me, what is the relationship between lithium and crude oil? So BP, British Petroleum, in 17, argued that the most of the world's liquid fuel in the transport sector, okay, 10 million barrels per day, its share of global demand remains below 60%. This case before COVID-19. Also, this transport produced 70% of total emissions of greenhouse gas, okay? To change this reality in the Paris Agreement, many countries, including 10 OPEC member countries, have focused the effort to deal with the impacts of climate change through appropriate financial flows, a new technology framework, and enhanced capacity building framework. And to achieve this reality, energy storage and electric mobility are having great relevance. If you see in the following figure, we see that there's 56% of global end-use lithium markets are used to get batteries. No, we can see the growth. No, the growth. Okay, well, the figure is related to the statement made by Hache et al. 2016, where the increase in global demand for electric vehicles means an increase in the lithium consumption, and as a result, the previous arguments may have an impact in the crude oil prices due to technological transition process and climate policy implications and the resulting of this. Okay, and all these are recollected in these papers that I put in this slide. Okay, so the substitution for crude oil by renewable energy inputs in the transport sector is a major concern for oil producers, and among the different types of clean energy, lithium is currently assuming an increasingly strategic role. Next, following the research line initiated by Monge and Gil-Alana 2018, Gil-Alana and Monge 2019, A and B, okay, where authors analyze the lithium production and estimated consumption, lithium and cobalt for automobile components and lithium industry in the behavior of merger acquisitions in the US oil and gas industry. In this research paper, we use continuous wavelet transform analysis to study the dynamics of the lithium industry and the better risk behavior of the 10 largest oil companies in the world. Also, we study the dynamics of the beta series by using long-run dependencies approaches, okay? So our data, the choice of oil companies for the data set was based on the fact that they are among the world's largest oil firms according to revenue and are listed in the largest stock markets. This criteria ensures that the chosen firms are among the largest players in the market and their stocks are highly liquid. Additionally, we considered only these 10 largest oil companies and no more because the markets for similar companies, in the case of the petroleum industry, have similar risks. According to the classification done by Thomson Reuters in 2019, our final data set was are represented in this table, starting by China Petroleum and Chemical Corporation and finalizing by Gazprom. Okay, these are the 10 companies. Also, we have used the exchange index to calculate the beta term of each company. This coefficient gives us about each security is more or less volatile than the market as a whole. It is a measure of the risk arising from exposure to general market movements as opposed to idiosyncratic factors. Okay. To represent the lithium industry, we have used Sol Active Global Lithium Index because this index tracks the performance of the largest and most liquid listed companies active in exploration and mining of lithium or the production of lithium batteries. Okay. The data have been obtained from Thomson Reuters Econ database and cover the period 11th February 2009 to 10th January 2019, and they are expressed in dollars. Okay, so first, to see the interconnections and the dynamic correlations between the lithium industry and the conventional beta term structure of oil companies change across different times, we use continuous wavelet transform analysis. You can see for more specific, for more technical details, you can see Aguiar Conradi and Suarez 2014. And also using this method, we are able to localize the structural changes over time. Next, once we get the result from continuous wavelet transform analysis, we will focus on the statistical properties, whereby we use fractional integration techniques to analyze the degree of persistence observed in the series, analyzing the stationary processes related to transitory shocks and permanent shocks. And also the same, for more info, you can see in the last point, the following papers, Monge and Gil-Alana 2020, and Monge and Gil-Alana 2021, among others, okay? So focusing on the results, in this slide and in the following, okay, in the slides 14 and 15, we display the wavelet coherency values to estimate how the lithium industry affects the behavior of the beta of each company and allow us to identify structural changes. We see that the intercorrelation, occur from a single day to 2 market years. We can observe, for example, in this slide, you can see in the left part the first graphic. In the left part, you can see the coherency, and in the right part is the coherency. So in the coherency part, we see the intercorrelation, okay, and we see that focusing again in the coherency part, we located at low frequency corresponding to cycles between these important parts are located in cycles between 32 to 198 days. Okay, the most important ones start around 2013, as you can see that for most of the cases. Okay, yes, for most of the cases, yes. Yes, focus. Okay, next, if we focus on the phase difference, that is the part B, okay, the right part of the panel, okay, we observe a negative correlation in this time period, finding that the beta term reflects an advance to the responsiveness of the oil companies to movements in the lithium markets. Okay, next we move to the long-term memory analysis, and I put 3 slides with different results, but across table 2 to 5, these values of D, that is the difference in parameter, is we observe that is higher than 1, no? So the fractional integration approach show the homogeneous across firms with V values, no? In that case, for example, you see in table 2, the linear time trend, you see in white noise,
We cannot hear you, Manuel. Your mic is off.
Now?
Yeah, it's okay now.
Okay, sorry.
Can you come back 20 seconds before, please? Thank you.
Yes, for sure. Yes. Yes, I am saying that in that case, I am speaking about the long-term memory analysis, okay? And I said that from table 2, across table 2 to 5, we display the estimated values of D, that are the difference in parameters. And I am saying that from table 2 to 5, we analyzed the beta term or the beta models with different parameters using, for example, in that case, white noise. Table 3 is estimated coefficients for selected models in table 2 with white noise, and also using autocorrelations, right? So we see in the 3 cases that the parameter D, that is the difference in parameter, is higher than 1, no? Being slightly above 1, nevertheless, they are still statistically significant above 1, and thus rejecting the hypothesis of a random error in the data and showing a lack of mean reversion because D is higher than 1. Okay, so to conclude, the results using a continuous Fourier transform technique show that there is a period that starts around 2013, telling us how important and strong the relation is between the time series, the high level of dependence, and continues until 2016. This occurred in the long run frequencies between 32 and 198 days, and about the results obtained by the phase difference, which give us information about the magnitude of the impact that a shock in one variable has on the other. And providing an economic explanation, we can conclude that the beta term reflects an advances the responsiveness of the oil companies to movements in the lithium markets. And next, concluding the fractionalization part approaches shows that the homogeneous results across firms, again, the values of D are slightly above 1, okay, and those rejecting the hypothesis of a random walk in the data and showing a lack mean reversion in the behavior of the time series. And that's all. Thank you very much for listening to me, and it will be a pleasure to answer your questions.
Thank you very much for your presentation. Very interesting presentation, Manuel. Are there any questions in the room? No question for the moment. Yes, sorry, please, Arturo. Yes.
Yeah, Manuel, sorry, more like wanted to a bit more know, because I'm not very do not know your methodology quite well, or the method, the wavelet transformation. So if you could just give some intuition of what we're expecting from the wavelet. So what can we know from the wavelet? I think it would be nice so I get to understand better the results.
Okay. I'm going to go to the, for example, this slide. Well, the intuition are two. First, you can measure the relation between both time series. In that case, lithium industry with respect to the beta to ExxonMobil. Okay. So, for example, or well, more clear, the lithium industry versus the beta of Chevron Corporation, okay? As you can see, for example, the high correlation between these two time series are located, for example, between the period 32 to 128, okay?
Okay.
And the period is concentrated between 2013 and, well, in that case is more than 2016, okay? And once you have located this correlation, then you can go to the phase difference, okay? And the phase difference is in the right part of the next to the coherency, no? And for example, if you see, you have to go to the first one, no? To the first graphic, the above graphic, okay? That is located between 0.5 to 255 frequency band, okay? Because we said that the period considered the high coherency, no, is located between 32 and 128, no?
Okay.
So you see, in that case, in this period, this coherency has a behavior considered between 0 and minus p.5. Okay. With this result, you go to the, for example, says that in that case the beta is advanced the behavior of the lithium behavior, no, the lithium industry behavior.
Great,
and
great.
This is explained in Aguiar and Conradia paper, okay, that I mentioned before.
Okay, great, thanks. Yeah, it makes sense now. Thank you.
Thank you, Arturo.
Thank you, Arturo. Are there any questions? From my side, I have one or two, maybe three questions. The first one is dedicated to the Solactive Global Lithium Index. Can you elaborate a little bit on that? What is it exactly?
Sorry, say again, because the connection.
What is it exactly?
Well, in the Solactive, the global Solactive Global Lithium Index collect the big firms that start from the exploring to mining to produce a lithium, the lithium component. Okay, and I take this index from. I don't build this index. I collect this data from Thomson Reuters. That is okay. Well, is in the database.
And why did you choose specifically lithium? Because you know, in the battery, in the lithium-ion battery, there are also nickel, cobalt, and manganese. Don't you think that? My question is, did you do a general study dedicated to all these metals that are very interesting components, you know, for the lithium-ion battery, or did you focus only on lithium?
No. Well, in that case, I only focus on the lithium industry because, like I said before, the oil companies are concerning because the main well, in that case, yes, the 60% before the pandemic episode, the 60% of oil was dedicated to transport sector. Okay, and now it seems that, well, or when I started the paper, no, it seems that well, yes, that the lithium is the next step to convert to the transport sector to more efficient, to more non-pollution transport, or you see. And for this case, I choose the lithium. But yes, are you okay? Why not study other industries, no, that affect the behavior of in the oil companies, no?
Yeah. I think it could be a very good way, you know, to extend extend your work, looking at cobalt, for example.
Thank you.
My next question is dedicated to the consequences of your work on the for the oil industry. Don't you think that, for example, the degree of diversification of the different oil companies that you put in your panel can affect the results?
Well, this is a good point. That it's a good point to study, but because with the pandemic, the oil industry, well, the behavior of oil industry have changed, because I don't know how affect for example, the expected inflation, no, the expected activity, that the expected demand, no, that we are going to see in the next few months, how to increase. Well, I don't know. It's a good point to study. Not only the period analyze it as it's a good point to study after this pandemic episode, no, how to affect the behavior, no, of this.
Yeah. Okay. My question. My question was, you know, do you think that in the future, for example, we could observe some kind of investment for the oil company, you know, in mining industry, and more especially in lithium?
Well, yes, no.
It could be very interesting stuff, you know, for them, you know, to diversify and to make some kind of portfolio diversification, more especially in metals and more especially in lithium or cobalt.
Yeah, I don't have an answer for this question, because, like I said before, could be an interesting point to have in your portfolio. You have an investment in petroleum, in the oil companies, no, in your portfolio. But I don't know, because like I said again, I said before again, the pandemic has changed, and this, for example, I have to extend these results to know how the movements of two variables of lithium industry and the oil companies, no, it have the same behavior like before. And I don't know. Well, I don't know answer to this because the time period, no, we don't have all the picture, no.
Okay, you know, it was not a question related directly to your work. It was just, you know, your feeling of what could happen, you know, in the future in terms of diversification.
Well,
if you do not have a clear answer, there is no problem.
No. I don't have clear the answer, because I have to see the data. I have to see the results again, including this last period, because this paper was published a few months ago, and with this data, and could be interesting to go ahead about taking the data, no, to now, and to see in the portfolio, in the risk, if it's interesting to maintain the oil companies in your portfolio. But I don't have.
Okay, thank you so much. Are there any other question? 1, 2, 3. So We'll switch to the last presentation and to the last presenter. So we'll have the opportunity, to see Arturo Regalado from the University of Aberdeen.
Okay,
Arturo, you have the floor.
Thank you very much, Emmanuel. Just quickly, just tell me, can you see my screen? Yep.
Yes, from my side, it's perfect.
Perfect. Yeah. Okay. So I think it's right. Okay. So let me take this out. Okay. So good morning, everybody. Thank you very much for attending today's session. Thank you very much also for coping with yet another Zoom meeting. My name is Arturo Regalado, and I will be presenting a paper I co-authored with my supervisors on the decision to decommission under oil price uncertainty and financial security obligations, a case study of the UKCS. We're interested in studying how is it that operators reach the decision to decommission, what are the factors that affect their decision to cease production and begin decommissioning activities on their oil projects under price uncertainty and financial security obligations. And without further ado, let's begin. So first of all, let's look at why is it that it's important to study decommission, and this is very useful to look at the decommissioning outlook of the United Kingdom continental shelf. First of all, nowadays, approximately 10% of the overall oil and gas industry expenditure in the UKCS has to do with decommissioning, and this will only increase as the years come by. As we are now a very mature hydrocarbon basin, most of the oil fields are reaching their end of their productive life, and decommissioning we set to become one of the main, if not the main, activity in the UKCS, as well as it will be the main activity in very much of the other mature hydrocarbon basins, especially as the energy transition takes hold and more and more oil fields are taken out of work. And so to look at this, we can see that in the UKCS, we're expected to have at least 12 stop sites removed each year up to 2025. Over the next decade, we will have approximately 150 wells to be decommissioned per year, over 6,000 kilometers of pipelines also in 10 years, and expenditures are really, really big. And there's a lot of money being put into decommissioning because, as we say, it's going to become the main feature of the UKCS. But why is it that operators decide to decommission? How or what factors they take into account for decommissioning? And first, there's a legal dimension to this. There is actually a legal obligation to decommission based on the OSPAR decision 98.3, which essentially requires all offshore oil and gas installations to be partially or fully removed from the sea to achieve a clear seabed in the North Atlantic, which the UKCS is part of this convention of the Oslo-Paris Convention. And then there's also a domestic legislation dimension to this, where the Petroleum Act of 1998 and also both of the energy amendments it has received have three principles that relate to decommissioning. The first one is the principle to achieve a clear seabed. Then it's also the polluter pays principle, which says that the beneficiaries of upstream activities should pay for decommissioning. And third, and perhaps more important to the topic of our paper, has to do with the principle of protecting taxpayers' money of the risk of funding decommissioning liabilities, because again, it is an obligation for operators to decommission, and the UK government wants to make sure that no taxpayers' money is used to fund decommissioning liabilities. But if these are the legal obligations and the legal answer to why we should decommission, we're actually interested in looking at the economics, the economic factors behind the decision to decommission. And we can see that, first of all, the decision to decommission can be approximated by a proxy variable called the decision to cease production, because when an operator decides to cease production, shut the field, then we can assume that they will begin decommissioning of the dismantling of all of the installations as soon as possible. And some determinants of here are, of course, first of all, oil price. And why? Because oil price basically affects most of decision making in the oil and gas industry. But we have also, as a very important feature in the UK, the issue of financial security obligations to procure decommissioning. Then we also have the decline rates. And why is it? Because, for example, if a field has a faster decline rate, it may accelerate cessation of production date compared to a field that has a very slow decline rate. So it's important to take into consideration. Also, costs like the operating costs and decommissioning costs can go and are determinants of the decision to cease production. But in our paper, we're going to focus on these first two that we think are very, very important. First of all, oil price, especially oil price uncertainty, because as we know, oil price is not fixed. It's not something we can easily predict, and also because financial security obligations are part of a of what the UK needs to do. And so let's go and check first of all some intuition behind these determinants. And why is it that oil price uncertainty affects cessation of production date? And here we can see this in a very simple plot of a cash flow where we have the operating costs here in gray, and also a case scenario of revenues, of a path of revenues. And the first assumption we do in our model is that cessation of production date takes place when revenues are less than OPEX. This means that the companies or the operator is facing an operating loss, is losing money, and therefore he will choose to cease production and begin decommissioning. But in this case, let's suppose we as operators make our model, our discounted cash flow model. We say that the revenues hit the OPEX at year T, and then we say, okay, we're going to have a cessation of production date at year T. But what happens if in any of these time periods, if we're planning to say at T-4 for decommissioning, what happens if there's a price bust, if oil price goes down? Then we need to accelerate our cessation of production date from point A to point B, because now revenues are lower because the price has decreased, and we will actually need to decrease to accelerate our cessation of production date. And the other way around is also true. If there's a price boom and price increases, then we can actually delay cessation of production date, because we can still make profits this period if we keep producing oil. So this is a very important question for operators to check at oil price uncertainty how it behaves. And actually here I am even showing some very well-behaved oil price curves, to say so, revenue paths because of oil price, when actually oil price can be something like this, and we actually don't know when we will be reaching this point. And so we argue that operators need to take into account oil price uncertainty in their discounted cash flow models, so they can make a very robust and better optimal decision to cease production. And if this is the case of oil price, now it is important to understand why financial security is also an issue and affects cessation of production date. And in this case, it is first of all because the regulatory framework for decommissioning in the UK has an underpinning principle to protect taxpayers from the risk of funding decommissioning liabilities. And make no mistake, the resources required are quite substantial. The Oil and Gas Authority expects the total cost to decommission the full inventory of offshore installations to be somewhere between 40 and 66 billion pounds. During the next decade, it is expected that around 2 billion pounds a year will be expended in decommissioning in the UKCS each year. So we need to secure those resources. There are a lot of resources needed to make sure that decommissioning takes place and it's not charged to taxpayers' money. And the way to do this is by procuring financial security through different financial instruments. And while in principle, there are many different instruments that can be used to procure financial security, UK legislation accepts the following 5 that I put here, with perhaps the letter of credit being the most famous and also very used in other geographies. And the way to do this is you actually pay for the financial security instrument, and then we argue that you should account for that additional cost of the security instrument in your discounted cash flow models, so you can reach the better decision to decommission. And let's go to some intuition again, and taking again our simple cash flow plot over here, we can see that if we keep everything else the same, if everything keeps constant, again we have at point A the decision to cease production. But if the operator neglects the added cost of security, he will actually be losing money, because once we account for security costs, we see that he will be losing money all the way through period T-1 until year T, and he should actually be accelerating again cessation of production date by 1 year to make sure he's not losing money over here. So the optimal decision to decommission should consider the cost of security. And this leads to our research question. What is the combined effect of oil price uncertainty and financial security on decommissioning, or specifically in the decision to cease production and begin decommissioning activity? And to this, we have developed an empirical strategy of 3 parts. The first one has to do with building a discounted cash flow model of 5 oil fields that are designed to be representative of UKCS assets of recent vintage. Here we have some of the model cost assumptions, and the main feature of these 5 fields are 2. The first one is the sizes. We're using a very small size field of 10 million barrels and also a very large field of 150 million barrels, and a range over here. And our costs are, we're making sure that our costs follow economies of scale structure, because as you know, as production increases in an oil field, we'll expect average cost to decrease. And then we calculate the cessation of production date for each of these fields, for each of our assumptions, based on the point where revenues are less than OPEX, that is, when we're making operating loss. And we assume that cessation of production is a proxy for the beginning of decommissioning, a proxy variable. And how do we introduce oil price uncertainty into our discounted cash flow model? Well, we do that through revenues. And first, we do it by modeling oil price uncertainty using 3 different stochastics processes: a random walk with drift, the geometric Brownian motion, and a mean reversion process. And we use these 3 processes because there is no real consensus on the literature for what the best process to use. Hamilton, Pindyke, there are several studies that eventually use or suggest these 3 types of processes. The geometric Brownian motion is very much used in the financial sector, but it appears, however, that some recent studies point out to mean reversion as the optimal underpinning process to model oil price uncertainty. And it makes a lot of sense because mean reversion has a theoretical sounding ground for oil price, because on a mean reversion process, we have that the variable under study fluctuates around an average value, around the mean. And this is more or less the case for petroleum, right? Oil price will increase until it's very until it makes some very macroeconomic distortions and demand will fall, so you will have a decreasing price. But if price decreases a lot, like what happened last year, you will have OPEC entering into the market, cutting production, making sure the price goes up, and it will be fluctuating around the mean. So mean reversion appears to make sense, but we don't know it is, and we would like to also contribute into the literature to say, okay, if you're gonna insert or account for uncertainty of oil price, you can have the option of these 3 models. Which one should you use? Which one introduces most uncertainty? And to analyze that, what we do is calibrate the parameters used in these 3 models: the drift, the volatility, the speed reversion process. We calibrate the models using annual spot price from the Energy Information Administration from 1987 to 2020. And we use annual spot prices because this type of decisions do not occur just because in 1 month we have operating losses. Operators actually hold for several periods of time, and they take these decisions like in some sort of a medium to long-term analysis, not in a monthly basis. So that's why we calibrate on annual spot prices. We do Monte Carlo simulations where we simulate 10,000 oil price paths of 30 years forecast for each of the models. And with those simulated price paths, we calculate the revenues that go into the discounted cash flow model. So we have a discounted cash flow model that accounts for oil price uncertainty via the revenues. Right. And second, we now have also to account for financial security in our discounted cash flow model. And here we have a very basic and essential net free cash flow that accounts for revenues, OPEX, CAPEX, decommissioning costs, the tax paid. And what we just need to do is actually account for security by adding this term security cost. But to calculate security cost, we need 2 elements. The first one is the number of years paying security, which is also like the timing of the contributions. How much time are we paying security? In principle, the government in the UK, the government can require security to be paid anytime in the project's lifetime. However, it has been customary in the UKCS to do that whenever the remaining net present value of the oil field is less than 150% of the present value of the decommissioning costs. And that's the point of trigger when you need to begin paying security. And once we have the number of years paying security, we now need to calculate the total cost of the security, how much the security instrument costs. And this will vary depending on the instrument you choose. And in our model, we're considering 2 instruments. First of all, we consider the letter of credit. The letter of credit is issued by a bank where the operator needs to pay a fee over the decommissioning costs to the bank. And it also has the question that it limits your borrowing capacity because you need to disclose the letter of credit in your books. And this is important to use because, first of all, it's very commonly used in the UKCS, but also in other geographies. So it's easy to generalize to other places. But it's also representative of types of instruments that require a fee on the decommissioning cost to be paid to the security issuer. For example, surety bonds, performance bonds, which are very used in the Gulf of Mexico. And then we have the second instrument, which is a trust fund, in which you need to make contributions, certain regular contributions to a fund that at the end of the year's paying security will be enough to meet the decommissioning costs. And this is very important because it's representative of instruments that are types of advanced payments of decommissioning. For example, cash deposits, you pay for decommissioning before it happens. So we use these 2 types of instruments in our empirical strategy and in our model. And now turning to results, we present two plots, two heat maps that basically sum up our results and our findings. And first of all, let's check oil price uncertainty and its effect on the cessation of production date and how much uncertainty they introduce. And by looking at these plots and reading through the columns, across columns, we can see that actually there's uncertainty in cessation of production dates as expected once we account for oil price uncertainty. And we measured it by the standard deviation of the different simulated cessation of production dates for each of the simulated revenue paths, 10,000 Monte Carlo simulations, etc. And we can see that even there are differences between the different stochastic processes that we use. And it appears that the mean reversion introduces more uncertainty into the COP. And this is a result that replicates on all the fields, no matter the field size. So it is important, first of all, to note here that you need, as an operator, to account for oil price uncertainty, because that way you can have more robust decision making, as you will take into consideration a wider range of possible values of your COP date. And if you're accounting for oil price uncertainty, then you can use the mean reversion process as it is the process that introduces more uncertainty. And it's also this is also good because it is consistent with the literature that has found that mean reversion perhaps is the best approach to model oil price uncertainty. And if we look, we read across rows, we can see what's the effect of the security agreement. Here we have a no security agreement, letter of credit, and the trust fund. And it appears, so what it's important here to remain is that uncertainty remains no matter the type of security agreement used, but we cannot see the effect really clear. However, from these results, we can actually derive some interesting conclusions. And the first one is that it is very difficult to predict the cessation of production date because there is uncertainty through oil price. And this is a very big problem for supply chain companies and the government. For supply chain companies, it is a very big problem because they need some certainty in COP dates just to plan for the machinery, workforce, human capital they need to perform or to carry out the commissioning duties. If they cannot predict the COP with some certainty, then they cannot muster all these resources required for the commissioning, and the commissioning will not take place. And the operator will need to search for other types of oil supply companies or supply chain companies, and this might in turn increase price and increase the commissioning costs altogether. And this is also important for the government because knowing now that it is difficult to predict the COP date and that there is uncertainty, they must be very aware and monitoring all the situation and engaging quickly with operators just to make sure that they will develop decommissioning programs well in advance of possible COP dates. And just to check and to see more clearly the effect of financial security instruments on the decision to cease production, we can see this plot here that shows this heat map that shows the change, the average change in years to COP compared to a base case scenario of no security agreement and no oil price uncertainty. In red, we have the cases where COP is accelerated by 1 year. In gray, we have no changes, and in blue, we have cases where COP is delayed by 1 year. And the most striking feature of this plot right away is that adding security, like here, for example, a lock or a trust fund, in general, accelerates COP by at least 1 year. This is even more stringent in the trust fund. In the case of the trust fund, you can see that for any case or any field size, you will have accelerated COP by 1 year. And if it's a big field, you will have it by at least on average a 2 year acceleration of the field. While the letter of credit appears to not affect very much the medium-sized fields, it does to the the bigger ones. And this is especially a problem for the small fields, right? Small projects, because in the small projects, you will be required security, any form of security to be given. And you know that your COP will be accelerated by 1 year, no matter the instrument you use. So this puts a lot of pressure on those. And here again, we can see that we can check, for example, for the mean reversion process and see how COP accelerates, and we derive more or less the same general conclusions. And the insights from these plots are that the contributions to a trust fund, which are advanced payments on decom, will most likely accelerate by at least 1 year the COP compared to no security agreement. And we also can see that letter of credit will impact mostly small developments. And why is it? Because in addition to accelerating COP, it will limit the borrow capacity of a small company or a small project because you need to disclose the COP in your books. So you may be at the least possible way to achieve or to get some credit to more developments. So small projects are at greater risk of having distortions to the COP decision making, and we see that actually oil price uncertainty and also financial instruments do introduce distortions in cessation of production dates. And so some future work that needs to be done here, there are actually many possible avenues of future research. The commissioning of offshore oil and gas installations is a topic that needs to be studied much more. There is very scant literature. It's also very dispersed. There's some in the Gulf of Mexico, very few here in the UKCS. And we actually need to begin studying this topic because the commissioning is said to be one of the main activities of the whole oil and gas industry, upstream industry. Because as the energy transition takes hold and more of the oil fields are done with their productive life, we will need to decommission those installations. And from our paper, we see three very clear ways how we can improve our modeling. First of all, changing or making variations to the assumption regarding the timing of the contributions, because our results are underpinned by our timing contribution. Maybe if we allow payments to be made through a longer period span of time, for example, for the trust fund, we will have not so strong effect. We can also check at the different decline rates. We use in this case very simple exponential decline rates, but what about hyperbolic, exponential, or logistic decline rates for the production of the fields? And also check differences in the variations of the tax regime. Finally, as concluding remarks, we know that these findings are useful way beyond academia because they can be used for decision making of the UK government. For example, deriving policy or guidelines for companies to procure certain instruments depending on the type of project they are doing. They can also be used within industry to maximize the value of the projects and procure good instruments based on the conditions. And now we can also know that this knowledge the knowledge in this area can also inform other geographies with heavy offshore activity like Southeast Asia and the Gulf of Mexico. And the project contributes in making the UKCS a relevant decommissioning hub, not only in engineering and technological developments as it stands now, but also in the economic understanding of the matter. So thank you very much, everybody, and all comments and suggestions are very much appreciated.
Thank you so much, Arturo, for this very dynamic presentation. Are there any questions in the room?
Hi, Arturo. I'm just going to ask quick question.
Please.
Yes, sorry.
Yeah. So how can we conclude about the uncertainty with the oil field size? If you could go back to your table, which shows the various financial instruments and the oil field size, the first table, I think.
This one over here.
Yeah.
Or this one?
Yeah, that one. Yeah, that one.
That one.
Yeah. So how can we conclude the uncertainty after we take into account all of those oil price stochastic process and the financial instruments with regards to the oil field size or oil field production?
Okay, production. Yep. So in this case, I think it's very interesting to note two things. That if you look at the plot, for example, we see that oil price uncertainty actually increases as field size increase. For example, here at the 10 million barrel, we have 1.1, for example, in the case of no security. And for mean reversion, and at the 150 million barrel, we have that it's 2.18. So it increased by almost 1, the COP. So this means like on average, we will have a 2-year difference between whatever was the base case scenario of COP date. So imagine if we have that the project will be developed, the original COP is year 20 of the project, we can have +2 or -2 years added to that COP when the oil field size increases. But I think, and that's why I see we have this plot, and I think actually it's more informative to look what happens in this other plot. Because
could you make it in full screen? Sorry.
Oh, sorry. Yeah, let me do this. Let me just quickly move to this one. Sorry, here. So as I was telling you, so if you check here, see, for example, in this point here, how as you increase oil field sizes, the standard deviation increases, right?
Yeah.
So it is informative to use this, but I think it doesn't convey the whole understanding of what it means for this field size, right? Because we know from this here we can derive, okay, yes, oil price uncertainty matters, right? But of course it matters, right? That will be one of the conclusions. But when we look at this plot actually here, we can see what's the effect depending on field size. And it is very clear, for example, if you look at the medium-sized fields, like the 25 and the 50 million barrel, you see that only, and in some cases only, the trust fund actually accelerates COP, right?
Okay.
and it's for the trust fund. But if you check the letter of credit or no security agreement, if there's no security agreement, even the 25 actually delays COP on average. Okay, so but it is not the case for, let's say, more extreme sized fields, like larger or smaller fields, where even in the case of the very big field, you can have like a 2-year acceleration of the COP date. So there appears to be a sensitivity of COP date by oil field size. We need to study that more. That's actually part of a very important part of my PhD research, is studying how the sensitivity affects. But we can also see, and this is more like a domain expertise domain conclusion here, that even if, for example, in a very big project, if you accelerate COP by 1 year or 2 years, it's not that much of a problem, because that will not break your project, right? You will still make a lot of money, you will have profits, and then PV will be high. But in a very small project that develops in around 8-9 years, accelerating your COP by 1 year can actually make or break your project. And this is very important to note, and this is also a part of that we need to do some research, because maybe the timing of the contributions can actually affect how this is affected, and that's why we say that the small projects are actually at greater risk of distortions on the COP.
Have you tried to link with the actual case of UKCS then for the field, some kind of like field real case in the UKCS with your simulated results?
I wanted to do that, but I wanted to do that, but it's very difficult, very difficult to get information on those because the companies consider it very sensitive information. What we did was design these 5 oil fields that are more or less representative of I did some checked some of the sizes that are of the recent vintages, cost structure based on the reports by Oil and Gas Authority, and we designed this on this approach, but no, regretfully we couldn't have access to, well, we could have some access. It will just be on 1 or 2 fields. It will not allow us to have like a very broad understanding of more oil fields, because companies are very sensitive about that data, regretfully.
Or probably you could just give like some of like grouping, like for the UKCS, like how many percentage belongs to this field size production, and then like how many percentage belongs to this, so you can combine with your preliminary results.
That's very interesting. Yeah, thank you very much for that point. Yeah, that will actually make a lot of sense. Yeah, thank you very much, Esti.
And also for the last slide for the future work, I think for the decline rate, I think exponential, you could have checked either exponential or the Weibull distributions that might be suitable for the declining field production size.
I actually make a work here where I, for example, Professor Kemp and Sola Kasim made a contribution like 15 years ago that appears that in the UKCS fields follow a logistic decline curve, a logistic decline rate, and I did this again, like an updated version of this, and apparently it is also again that the logistic curve is one that best replicates the decline rates. And it's interesting because, for example, I don't know, the Bible might be a very good curve to fit, but now also if we see that the logistic fits well, it's more intuitive and easy to explain to a stakeholder what like the logistic curve means in terms of the decline rate. Like it's, you know, you have just this big spike and then it's slowly tends to zero. So that's why we're putting this, but yeah, I can definitely check into other types of distributions.
Oh, sorry, I mean not exponential. Exponential is more about the timing, but log normal, just
the log normal. Okay,
okay, thank you, Arturo. Great presentation.
Thank you, Steve.
Thank you very much for this very interesting question and answer. Are there any question? So maybe I can make a very general comment, because I'm not a specialist at all, you know, regarding your topics. But you know, after looking at your presentation, I consider that this is some kind of hidden topics of the energy transition. And the fact is that, you know, I was very impressed by the number and the figures that you presented on your slide 1. You know, and if I remember, 10% of the expenditure of the oil and gas industry is actually, and so I have one or two questions. Do you have an idea of the total amount of money that will be needed, you know, for decommissioning?
So it's expected to be around 40 or 66 billion pounds to decommission the full inventory of offshore oil and gas installation, the full inventory. And nowadays, the closest outlook we have is 1.5 or 2 billion pounds a year on decommissioning only during the next during the next 10 years. But this is a very conservative, actually a very conservative outlook. It is expected in the next 5 years to increase a lot more because the fields are declining quite fast. Also, the energy transition in the UK is gaining a lot of traction and gaining a lot of hold. So there's also like some, how to say, like some public pressure to ensure that the decommissioning takes place as fast as possible. So we can expect actually these expenditures to increase quite substantially.
Okay, and just because you mentioned, you know, during your answer to ST, the fact that you do not have access, you know, to oil and gas company data, don't you think that it could be a very a win-win agreement, considering the fact that you have a very interesting methodology that can help them, you know, to reduce the risk regarding decommissioning, and because you have a very, very interesting methodology, is there an agreement is possible, you know, in this field or not?
So yeah, actually, one of my sponsors is the National Decommissioning Center, which is part of a body called Oil and Gas UK here. That is like the trading body of the industry here in the UK.
Okay.
And so there are ways like to get to some of the companies, but let's say that maybe when I discuss this with the sponsor, the way to go around this will be just to have a research, but it's like proprietary and just for the company.
Okay.
they won't even like to, you know, okay, you can use this data, but just say it's anonymous or whatever. Because, for example, and it makes sense to some extent, because if I use some cost structure and I say some figure field size barrel, they can say, oh, it is this field, right? It is this what's happening, and they are very sensitive on those type of data. So it can be possible if. So I think that what they are waiting is, okay, if the research goes through this type of peer-reviewed process and it goes on, maybe we can have this to be developed as a methodology and applied with some of our the sponsor and some of the industries, but will surely be like proprietary and maybe even an inside job to say so.
Okay, thank you. And my last question: are there any other research centers that are working on these topics, and where?
Yeah, so that's a very good question, and actually it's part of my literature review. You see, my literature review is like very very small, it's very scant.
Yeah,
literature is beginning to actually gain track. There's literature, for example, for mine closures, the commissioning of nuclear plants, but offshore oil and gas decommissioning has its own challenges that need to be addressed. We can draw on that literature, yes, of course, but offshore decommissioning, let's say, it's still evolving to this point. And so we have the National Decommissioning Center. The University of Aberdeen does a lot of work on this. I think Dundee University does some. In the Gulf of Mexico, there is some research in the Gulf of Mexico, but I don't think it's part of a center. It's more like 2-3 authors that have worked this topic, but not like in a center for energy transition or something like that.
Yeah. Okay. Thank you very much. Very, very interesting.
Thank you.
So are there any question? We have 10 minutes, so it means that if you want to ask question to all the presenter, it's possible. We have 10 minutes now.
I actually have something for Sania, if she's still there.
I think she is.
Hey, Sania. So your presentation, it was really very interesting, and also some of the tools. What did you use to show the slides with the interactive plots? Is it Power BI?
I have exactly the same question. I was very impressed, you know, by this presentation.
I'm using actually R. So there's a package called Zaringan, so that helps you to actually create interactive
in the presentation, because I know, for example, you can use the LaTeX or the Beamer, right? It's like the normal tool, but this one, nice, interesting. Yeah, very cool. I think, and it's very interesting because you can show clearly like pre-financial topics, post-financial, and go with it. Yeah, very, very, very cool.
Yes, and you don't need, to make 10 or 15 slides more.
Yes,
So it's very efficient. Are there any other question? No. So let's finish now. It was a very interesting presentations, and I would like to thank all the presenter and to thank all the topics we were discussing this morning, and I consider it was a very interesting session. So thank you everyone, and I wish you a good day or a good evening, depending on where you are now. Thank you so much.
Thank you very much.
Thank you for having us.
Thank you.
Thank you.
Bye-bye.
Thank you.
Bye.
Bye.
Bye.